have to lose money. If you don't lose money in markets, it will get you eventually. And the problem is if you don't lose little bits here and there, you'll lose a lot one day, and it just sucks. So everyone has to pay their tuition. It's just one of those hard realities, but you learn some amazing lessons. Most people don't realize that buying here in January, when everybody's buying, is actually the wrong time to be buying. That's the sell time.
Welcome back to another monthly on-chain analysis update with our expert Checkmate from Glassnode. How are you, mate?
Good, mate. Great to be here again.
Right, we're going to take two. Our internets, we're both living abroad at the moment, so I'm on hotspot. Hopefully this works.
Living the digital nomad problems of finding internet.
Right, huge episode today, mate. We've got the world's going to shit, just like every other month, apparently. We've got tech stocks trading like shit coins. We've got inflation, cost of living. We've got the spot ETF. We've got bond yields exploding, balances on exchanges. It seems to be the narrative keeps sort of changing. Keen to get into all this sort of stuff and just sort of try and figure out what on earth is going on and where we're going from here. Maybe let's start with, I don't know really where to start. Let's start with where we sort of ended last month about just the rising inflation rates, cost of living going up, on-chain data was looking super bullish. Obviously prices chopping sideways. What's your sort of general take and thesis on where things are at?
For sure. And, in some of these posts I put out recently, I'm just trying to really convey how absolutely confusing this time is, right? And, the hard reality is that there's not a single analyst alive who's ever dealt with, or, investors in general, who's dealt with this kind of combination of challenges. At the end of the day, it's a lot of it is being driven by the new monster of inflation. And this is something that we haven't seen in markets for decades. Since the 70s, arguably, and then, the closest analog is probably the 40s. When you actually go back and look at, all the debt to GDPs and things like that, the 1940s, and I think Lynn Alden does a good job of really capturing this, is where we actually have similar levels of debt combined with an inflationary regime. And a lot of that was obviously driven by by World War II. And, the world has basically been structurally geared towards deflation. And, a deflationary environment essentially means that bond yields continue to go lower, money continues to get looser, as a result of central banks continuing to try and fight these recessions and push them back. Essentially, rates just go on this perpetual trend downwards. Now, the challenge is that we're now in a regime where we're seeing deglobalization. We're seeing, nations wanting to bring back and onshore a lot of their manufacturing. We've realized, through COVID and through all these supply chain disruptions, just how vulnerable they really are, having delegated, a huge portion of their industrial capacity elsewhere. We've seen, decade or so of Wall Street saying, yeah, no, we're not going to invest in oil and gas and commodities and all these things because they're bad for the environment and ESG and all this kind of stuff. And suddenly we realize, well, you kind of forgot to build the green infrastructure. So it's all cute to say that we don't need oil anymore, but you can stop drilling for oil. But then if you don't build the alternative, eventually you're going to run out of oil. And, oil is the number one input cost to everything, whether it's shipping, whether it's, manufacturing plastics, whatever it is. Oil is the input to all of these costs. And, a lot of people didn't realize that natural gas, and this is something I've only learnt recently, natural gas is one of the key inputs into ammonia, which is one of the key inputs into fertilizer. So you see these knock-on effects, and when you actually lay out the scope of inflationary pressures, they're massive, they're structural, they're not going anywhere anytime soon, and the market is simply not geared for this. So as we see bond yields rising, the market freaks out because suddenly they expect bond yields to keep going higher. The Fed is massively behind the curve on fighting it. We've now got this system where a lot of this inflation is getting locked in, whether it's through wage increases or $102 oil, pick your challenge. But yeah, it's a new regime. The market's not ready for it, and it's going to have serious unwinding effects the same way that deflation had, winding up effects. It's going to be equal and opposite in the other direction.
Yeah, no, all valid points. And if we tie that with Bitcoin and where the markets are going at the moment, I think what we're seeing at a vast scale is people moving towards that risk-off sort of investment strategy. And I think we're seeing, the correlation of Bitcoin to tech stocks, NASDAQ is, we've seen that time and time again, it's, super, super correlated. Is that just an education difference, you think, for the majority of investors in Bitcoin, that they are selling off Bitcoin because they are seeing that as like a risky asset? or what's your sort of opinion on that?
Yeah, this is a really interesting topic, and the honest answer is I don't know. But my gut feel, and you're right that we've seen this correlation between Bitcoin and tech stocks, through the roof. So let's just take the base case. We understand that deflation's been the case for 40 years, and that's been beneficial for tech stocks, growth stocks, crypto, the whole lot. So in many ways, we would expect that if we move into a tightening regime, be it via inflation, be it via Fed tightening, or the combination of all of the above, then in theory we should be seeing the exact opposite play out, right? So all these tech stocks with completely insane PE ratios, we start to expect them to unwind. And you mentioned that we're seeing Facebook drop 25% in a single candle. Netflix got completely down 70% from the highs and continues to bleed. These are 100 billion $100 billion trillion companies that are just getting completely sliced in half. It is truly unbelievable. And I guess what we've seen is this kind of compression of all of this risk that's been suppressed by central bank policy for decades. All of that kind of pressure, like a pressure cooker, is finally coming out. You can't hide that volatility. It's going to come out eventually, and it comes out in increasingly violent bouts. Now, in terms of where Bitcoin fits into all of this, it's a very interesting topic because, sure, the correlation is there. But, and maybe this is me as a hodler kind of looking at it from the 20,000 foot view. But when I look at BTC kind of trading between 42 and 38 for 3 months, despite the fact that bond yields are screaming higher, the dollar's now above 102, oil's at $103, the world is in serious trouble. And Bitcoin is just cruising around this $4,000 range. So yes, there's a correlation, and yes, it's high. And yes, that does mean that we need to be very prepared for some kind of risk event. Personally, I think stocks are in for a pretty hard time. So if you assume that this correlation is real and it's going to stick around, then I would expect that Bitcoin could very well take a dive alongside stocks if they get slashed. Now, the second thing that I look at is I go, well, it's also, we've seen these 25% moves, and the market kind of knows that it's not going to get better. It's priced in a lot of stuff getting worse, to be honest. And here's Bitcoin chopping around between 38,000 and 42. Where are the bears? So I'm certainly not going to discount that we need to have some kind of serious, cutting, maybe not a cutting half, but certainly some kind of capitulation wick. But I'm also looking at this thing and saying, well, where is it, right? What else needs to happen? Do we need another war? Do we need more inflation? Do we need a 10% inflation print? What do the bears need to push this damn thing to just set a local low? Not even just take out 33, take out 35, right? What the hell do the bears need to actually trigger this thing? And it's just this gut feeling I have. And then we look at the on-chain data, and hodlers don't seem to care. And if I was to summarize what I think is going on, it kind of aligns, I've said this a number of times. Sometimes I try and find myself in the data, and I know the next 6 months are going to be completely hairy. I know it's going to be insane. I'm prepared to weather whatever drawdown comes. But do I think that they're not going to have to print money to solve this problem? Do I think that they're, at the end of the day, what tools do they really have? They're going to need to debase the currency at the end of the day. Is there going to be more than 21 million Bitcoin? No. Does my thesis change in any way, shape, or form given the amount of debt that we have? No. Am I willing to wait out 6 months, 12 months and accumulate through that period? Absolutely. Right? It feels like 2019 to me. So when I look at all of that in context, I kind of see a lot of people like me. There's no retail. We can see this in Google Trends. There's just zero retail. So, to me, this feels like an accumulation period. And, you've seen me say in some of the posts before, you can't go back and undo, right? So let's say we wind this thing forward 6 months. Let's just imagine that Bitcoin does go on a run, and we do see all this debasement stuff coming on. There's going to be stacks of people who are going to look back and go, gee, I wish I bought at 40,000, but you can't wind the clock back. Now, you can stack cash, right, and have that cash on the sideline waiting for that opportunity to come by. You can do the dollar cost average approach, where you kind of just, chew away as you go, which is certainly my strategy. But you can't undo. And many, many people won't stack the cash. They'll go and spend it on something else, and they're like, Bitcoin's in a bear market. I'll come back when it's in a bull. Mm-hmm. And they'll buy it 100K, and we'll go through this whole process yet again. So it's one of those interesting things where if you've got that medium to long-term view, feels more like opportunity than it does risk, in my view.
You raised some really good points, which I spoke about yesterday, I think, in a video, was around the accumulation phase. I think for so many people, fundamentally, they think making money in crypto is when all the excitement's happening, where they're chasing ApeCoin or they're chasing Moonbirds. It's like, no, like the time to get in is when the minority is looking at those opportunities. Like right now, like you said, it's back in 2019. Shit's boring right now. Like it's utterly boring.
Absolutely.
Like it's just like there's nothing happening, and that is like the wake up calls for those that have been in the market to go, okay, this is probably the time to be investing right now. You know, and the fact that you said we are ranging between 38 and 42, considering, I mean, what did Netflix, you know, after market the other day, was it down like 20-30% in the aftermarket? Like
It's crazy.
It's extraordinary.
It's amazing. I mean, these numbers
Yeah.
are these are tens to hundreds of billions of dollars just evaporating. It's amazing.
Yeah. I saw that Bill Ackman, I think, you know, he lost $400 million overnight off his fund, and you know, but funnily enough, that's like a 2%. I don't know if it was 2% loss that he did on his total capital. Like the amount of money, this is what continues to fathom me. The amount of money that is actually in the world is phenomenal, and how little
Absolutely.
of that is actually in Bitcoin, right? Like if we think about you know, Bitcoin in terms of where we are versus, you know, we tend to live in a bubble a little bit, you know, us crypto people, and think, you know, the world evolves around crypto, but the reality is it doesn't. And we are very small in terms of the money that's out there right now. And I'd love to get your opinion on where you think and how long it's going to take. We always talk about, like, you know, the institutions are coming into this sort of shit, but like the reality of like the sovereign wealth funds, I heard this over time and time again at the Bitcoin conference, the sovereign wealth funds are waiting for policy, and the government and the policymakers to basically allow those people to come into Bitcoin and know it's a safe investment. I'm not sure if you've got a viewpoint on that, but that continues to fathom me how small we are versus the opportunity at large over the next 5-10 years.
Oh, absolutely. I mean, when you look at it, I mean, you're right that all these big funds, whether they're sovereign funds or big banks or whatever they are, the bigger these things are, the longer it takes, the more regulations, the more clarity, and all that will happen. Now, how long that takes is anyone's guess. It's on the order of years, right? So, but at the end of the day, this is why Bitcoin is such an amazing, I guess, opportunity for people, you know, individuals, is that we have that access before all of these institutions have it. So, you know, those who have the edge and can kind of find that secret source before the institutions even get on board, that's where the generational opportunities start to show up. Now, in terms of what I think is kind of, I mean, you know, we talk about gradually then suddenly, and I think that is just the absolute perfect framework. And we've all seen over the last, I mean, let's face it, let's go back to 2019. It was a slowly phase, right? For everything, not just Bitcoin, but for everything. It was just kind of grinding along, status quo. And we saw the world speed up. You know, we heard a lot of people talk about COVID as like an accelerant, right? Whether it's people working from home or shifts in energy markets and supply chains and all that kind of stuff. These things that were starting to happen, but the virus kind of accelerated, and the government response to it accelerated all these things, and we started to move into the suddenly phase. And then let's even go that one step further. The last 6 months, the world is a completely different place, right? Even the last 3 months, right? Since the whole Russia-Ukraine thing broke out, the world's a very, very different place. And for any of you who kind of follow the macroeconomic side of things, particularly, you know, Luke Groman and his ilk, you know, they've been talking about what happens now that nation states have just seen US treasuries get frozen for the Russian central bank, right? Irrespective of what you think about the war, we've just seen that sovereign funds of the 12th biggest nation in the world, one of the largest, I mean, in nuclear power, had their assets literally frozen. I mean, even Australia is finally, right, returning its gold back to its shores. It still amazes me that Australia is, you know, it's not like we don't have enough space. We didn't have a single vault to hold our nation's gold. And further to that, over the last, I can't remember the exact timeline, but I'm just going to spitball and say 20 years, Australia made the all-wise decision of selling all but 8% of our gold. So now we're seeing, when you see a nation like Australia, right, fairly stable, pulling their gold out of London to put onshore, and then you kind of, at the same time that you're seeing, you know, Russia's reserves getting frozen, we're starting to see a shift in terms of what is the right savings vehicle for nation states, right? And the default is absolutely going to be gold, right? So I do think that the era of gold is coming finally. Peter Schiff might have his day. But simultaneously, you know, we all know that Bitcoin is, in almost every way, a superior version of gold. It's never going to completely replace it. Gold will always have its position and its place. it's kind of the most final settlement you get. Once you send the military ships and you ship all those bars of gold and you do all that millions of dollars worth of absolute pain to repatriate your gold, once it's in the vault, that's it. That's savings. Now, there's also going to be periods of time, and this is kind of me speculating on where I think this goes. There's going to be an advantage to being able to zip gold across the internet very, very quickly. Whether it's for settling for oil trade or national, whatever it is, food supplies or whatever the securing asset and commodities are. There's a need for like a liquid gold, and small countries will experiment with this first. El Salvador, and there was some announcement about Africa as well. Like all those little edge cases are going to start happening. But eventually, there's going to be an advantage to saying, well, we're kind of constantly settling these things. I don't really want to send a warship full of gold every 2 months. So why don't we just start with a Bitcoin transaction? And suddenly we start getting that 0.01% of trade happening in BTC. And then people, nation states, corporations, energy giants, oil giants are getting into the mining game. All these things just start, with that 0.001% usage, allocation. Hey, this is kind of useful. 0.1%, 1%, 5%. This is the kind of ball that I think is going to start rolling. And, the numbers that you start thinking about once you just allocate 5% of the nation's gold. I think Arthur Hayes had a great piece on this, where he just looked at what would happen if nations started allocating 0.1%, 1%, 2%. And the numbers are they're just enormous, right? We're talking about $1 million BTC. And in many ways, it kind of is closer to reality than we all expect. So it's an exciting time. The other thing that I'd probably just put alongside this is I'm not seeing a great deal of momentum towards using anything else in the crypto space. Like countries aren't going to be settling oil trades in Dogecoin. So I actually genuinely think that the era of Bitcoin and gold is probably much closer than people expect. I'm not actually that structurally bullish on altcoins at the moment because I just don't see their value proposition in this type of environment. Again, I've been wrong on altcoins for a long time, but I can't look at this macro landscape and find myself wanting to go out and buy Solana, to hedge this kind of risk. It's just not, it doesn't kind of click for me. Again, I've been wrong for a long time on this kind of stuff, but I'm not seeing that the same kind of demand profile at that scale. But, we will see how this all plays out.
Yeah, really good points. And I think on the altcoins side, what I've been seeing is just a lot of value being extracted from a lot of the altcoins. I mean, we're seeing tech stocks being sold off. Like, do you want to hold a, 1 to 5,000 sort of ranked asset on CoinGecko, or, holding sort of Netflix stocks? Like, it's all going to be pretty bad, I think, in the short to medium term.
And all the tailwinds that have helped VCs with cheap money, right? And that is the hard reality. The vast majority of altcoins are not really, they're basically propped up by VCs and trading funds, right? And as soon as that cheap money access goes away, which is increasingly happening, we should absolutely be expecting the unwind of a lot of that. They simply won't have the money to prop these things up. There won't be the returns. There won't be the interest. They actually do need retail to come in and buy this stuff and speculate for them to essentially milk the amount of volatility that's in the system. And if we're not getting that because the cheap money isn't there, for every retail customer who's got to spend more on their petrol and their bread, they are literally going to have less money to buy shitcoins. So, as much as it's a huge cyclical part of this industry, the marginal buyer literally has less money now. And unless their wages start seriously increasing, they're just not going to have the disposable income to be speculating on this kind of stuff. So I'm not bullish on altcoins at the moment for a lot of those reasons. The VCs don't have the money, the retail doesn't have the money, the interest isn't there. There's just a lot of headwinds that I see in the immediate term. And Bitcoin's not free of that, right? It does still have to kick this correlation before things really start to move.
It's probably a good segue, mate, to maybe jump into a couple of charts that you're looking at on chain and just see, because I know you've been speaking a lot about in our platform. The things aren't, well, they're not necessarily clear right now, but there's still some pretty bullish things happening on chain, especially around the supply of holders that haven't sold in over a year, supply on exchanges, things like that. But yeah, I'll hand over to you too.
No worries. You can see my screen?
Yep, got it.
Fantastic. So I mean, I think the first thing to look at is just, not on chain, but, people say that interest over time and Google Trends and stuff is, variable in use. But I mean, you can see here that we're not exactly in bull season. So, I mean, and this is the thing, right? We spoke about this at the start of the call. Most people don't realize that buying here in January, when everybody's buying, is actually the wrong time to be buying. That's the sell time, right? When you've got these big peaks, that's the time to be offloading if you're a trader. When you've got interest down here at these levels, that's actually where it's the most hated asset. No one cares. Everyone's lost money. The only people who are left are hodlers. So when the only people left are hodlers, they're buyers. They're not sellers on net. You kind of enter this regime where it's like, so you're selling when there's literally no sellers left. That's kind of the frame of reference that a lot of people simply can't understand, is that if you want to be the contrarian, you want to buy when nobody's buying and sell when nobody's selling, right? Well, then the smart money's selling. So this kind of reversal of everything that most people haven't, they still to this day, the amount of Twitter replies that I get, they're like, yeah, but this metric should be high during a bull market. It's like, yeah, it's high because you're getting dumped on, sir. That's why the metric is high. So it's kind of about thinking about the other direction. Now, in terms of the on-chain side of things, let me just pull up. I think the right one is active entities for this. So we talk about on-chain activity a lot, right? Whether it's addresses, whether it's transaction counts. I really like it. It's a really simple framework, and you can see the bull, you can see the bear, and you can see we're in this kind of middle phase. It looks like a little bit like 2019. We've recovered from the absolute worst phase of the bear, which is down here in July. You can see that it's not bull market season, but it's also not a downtrend. So we do have more people coming into the network. Let me chuck this on a line because you can kind of see it a bit clearer. You can see that we're just kind of chopping around. And, at the all-time high, we're essentially chopping around at activity levels that's similar to the all-time high, which we know was hodler driven. This is bull market retail. We can see the difference between this level and the bull market retail. This is just hodlers. And we've kind of held this group of people, and to be fair, slightly grinding higher over the last couple of months. Now, we're seeing growing activity. I think this is something to really take away. Let's compare it to our 2018 period. 2018 at the lows, right? This is when Bitcoin was going to 1K. Everyone was thinking it was going to 1K. But we had this growing activity. More and more people were interested in the asset. And here we are grinding sideways for 3 months. And more people are coming into the asset. So it's a positive growth. It's a divergence. We have a positive divergence in play. Doesn't mean it's not going to dissolve. Doesn't mean it can't deteriorate to something else. But we do have this kind of growing activity despite some pretty unfortunate price action. There's more people stepping in to buy this thing than not. Now this chart, this one I was playing with just before we jumped on the call. I've got 2 traces on here. I'll just step through them one at a time. This is our exchange flows, right? So again, I like to use exchange flows as kind of it's part of my analysis, it's not my whole analysis, because coins flowing out of exchanges is good. I'd rather see them out than in. But simultaneously, there's nuance, right? Sometimes people are just collateralizing loans and all the rest of it. But if we just take the last 2 years of price action, we can see that we had a lot of outflows. A lot of this was driven by GBTC arbitrage and institutions getting in and Michael Saylor, so on and so forth. You can see that it really calmed down following January, right? This is as the GBTC arbitrage really closed up and we actually moved it to a discount. And then during the sell-off in May, you can see a massive amount of coins flowing back into exchanges, right? People panicked, people sold, people exited. So of course, they're not one-to-one, but outflows, constructive, inflows, generally destructive. Now, we've kind of seen, I was expecting, we got a second 50% correction, 3 months of sideways, but we haven't got anything that looks like this. In fact, we have the opposite. We have all of these coins flowing out of exchanges, which is interesting, right? So that's a data point. So then what I'm going to whack on is this one here, which is the inverted version of illiquid supply change. Now, again, illiquid supply isn't everything. It doesn't give us probabilities. All it's showing is coins that are flowing into wallets with no history of spending. If you're a dollar cost averager like myself and you withdraw your coins once a month, once every 2 months, then essentially, if that wallet has never spent, you've created an illiquid coin. Mm-hmm. And we can see a very similar pattern. They're not one-to-one, but we can see that there's a influx. This is people selling their illiquid coins, turning them from illiquid into liquid. It matches up with our exchange flows. And here we are with this growing. I think this is the most important thing. From the exact bottom, the 33,000 bottom that we had back here in January, note the acceleration of both exchange outflows and illiquid supply. We are seeing coins come out of exchanges into illiquid wallets. And the most important thing, much the same as March 2020 kind of signaled that change in flows from net inflows to outflows, this bottom has, at this point, it's created an acceleration. There is more demand happening as this consolidation goes on. Even though price looks like shit, it kind of doesn't matter if you're a long-term investor because we're seeing these coins get sucked out, right? So it's kind of painting this very interesting picture that the demand profile seems to be increasing at the same time that we're seeing, all the bearish news and some pretty crappy price action and every trader in the world saying, look at this TA chart going to 10K. There's a lot of stuff underneath that rate of change. We're seeing the HODL sticking around even through some pretty nasty stuff. But I might just pause there and see if you've got any comments or thoughts on that.
Yeah, I think, as you mentioned, and it's been pretty common all this year when we've done these catch-ups, that it's been continually sort of a bullish outlook. I think what you touched on it there, and I'll probably iterate it, is that, what we're looking at here and, what we teach at Collective Shift, and, I think you have the same thesis as well, Checkmate, is around, we're here for a long time. Like, we're long-term investors. And, if you're looking for the shorter term in and out, sort of trading analysis, that's not what we're delivering here today. What we're delivering is like where we're going to be in 1, 2, 5, 10 years time. And, everything we're seeing is continuing to be bullish, whether it be the macro, whether it be the on-chain analytics, like everything is continuing for Bitcoin. Nothing's fundamentally changing. If anything, it's getting stronger. What can happen in the short term, as we know, who knows? And really, for me, who cares? Because it doesn't matter, really. What we're seeing is that things are continuing to be bullish, and we're not seeing that huge inflow of new retail investors, but the guys that are staying, the OGs, the hodlers, are continuing to hodl and DCAing in because they know this is a time to buy. And when the retail comes in and we get those exchange outflows, the price is going to be a lot higher. We could be, towards the sort of the six digits at that point, and then maybe we're taking profits at that point. So, yeah, I think everything is still setting up pretty bullish.
And I think a lot of people forget that hodlers include institutions, right? And the scale of money that's coming into this space. I mean, what a lot of people don't realize is when we look at the exchange balance, right? This is just all exchanges. And we can see here, right? Here's again that rate of change. Something happened on March 2020 that changed the market's perception. If we look at the entire history, I mean, it's clear as day that something changed on March 2020. And, here we are, zooming in on this current zone. We've had this rate of change. Look at this acceleration as we have this correction, right? We're getting to the lows. The market has seen something has changed and evolved. And if we look at where we are and we just map it across, we've got exchanges, essentially this entire mountain of coins that flowed in from the end of 2018 onwards has now essentially been completely removed. However, these coins flowed in at 6,000, 4,000, 10,000, right? Let's just say an average of $10,000. And here those coins are being sucked out of the exchange at 40,000, at 50,000, at 30,000. So we're talking 3 to 5x higher, which means that 3 to 5x more dollars has come into Bitcoin to absorb those coins, right? So the coins that went in at 4,000 are getting sucked out at 40,000. And, it kind of shows that level of capital inflows. And one of the ultimate metrics, where are we? Realized cap. If I hear a lot of people say, how do we know that there's actual money coming into Bitcoin? And there is one metric that shows this entire thing, and that is the realized cap. Because this thing can only climb when someone who bought their coins at 10,000, 5,000, 6,000 sells them at 60, because they're getting revalued by that 10x value. So the upward slope of the realized cap is actually showing that money is coming into the system. It just by definition has to. Someone with a bigger pocketbook came in and bought off an OG who bought their coins cheaper. And this cycle continues to play on time and time again. So, we are seeing this kind of step functions. Bitcoin goes through these phases where it gets repriced, right? It just takes the elevator up. And then it takes a year, 2 years, whatever it is, to just kind of grind sideways and reestablish the price floor. Again, when you actually look at this in a macro log scale view, it's just a sideways consolidation. The market's just tussling around trying to work out exactly what Bitcoin's worth. But we don't have these massive downwards volatility and, these multiple, this was just chaos, right? 2018, for any of you who were there, it was just an absolute roller coaster. This feels far more structured. It feels more institutional. It's slower. It's a bigger moving beast. And as a result, we should expect it to take longer to digest these moves. But over time, it's kind of that long-term savings vehicle. It's kind of what you want, right? The volatility is coming out of the market, even if people don't want to accept it. We are seeing that volatility coming out. We are seeing it get more institutionalized. And this is going to happen to every asset. Let's say Ethereum continues to survive. It too, once it gets up to the $1 trillion mark, it's going to slow down. It's not going to keep running at the speed that it always does. You can argue that creates all the altcoin opportunities further down the risk stack, probably will, but we have to accept that the bigger these things get, the slower they move, and Bitcoin as a $1 trillion asset will be faster than as a 10, as a 20, as a $50 trillion asset. It's going to get there, but it is going to take time, and it's going to slow down over that process.
Yeah, very valid. And I think we'll probably be sitting here in 6 or 12 months' time, looking back even 2 or 3 years' time and going, you know what? That was playbook. 2022 was the year of accumulation. Absolute playbook. And I think it's going to be, for those people that understood where we are right now and are DCAing in, putting in their capital, continuing to buy, they're going to be, healthily rewarded for it, I think, in the next couple of years.
And that's it. And it is the most important thing to establish. So I'm just looking for here it is here. It is the most important thing to understand your personal timeline, right? Why are you buying Bitcoin? Are you buying it for the next week? If so, you're looking more into these trading indicators. If you're looking into things for me, it's 2030 check. That's who I'm buying for. If I wait for 2030, then, 40,000, 38,000 is a kind of a rounding error. In the grand scheme of things, when you look at the scale of it, when you look at nation states, those 1%, 2%, 3% of dollars coming in, it's that 2019 type phase. And look, in terms of actually assessing risk, because let's just take into account that we could get a complete flush out. Right, this could happen. Let's put it into our series of probabilities. This is a metric that I've been paying a lot of attention to. You see me kind of cover it in a number of the videos. And it's a massively underexplored metric. There's a lot going on to it. I don't even think the author of it fully understands what has gone on to this metric. But basically, we've got our realized price down here in blue. Now, anecdotally, just from talking to various people, fund managers and all the rest of it, the industry, and when I say industry, I'm talking about the big funds, the guys who actually have these billions of dollars to deploy. They are very aware of the realized price. The realized price and the realized cap is a very known metric, right? It's kind of the first. Any fund who knows anything about on-chain analysis generally understands the realized cap as the aggregate cost basis for the market. Now, what Dor Shahar, who originally came up with this metric, kind of discovered, is he divided it by liveliness. Now, liveliness is a metric that goes between 0 and 1. And for any of you who kind of know fractions, if you put a number between 0 and 1 in the denominator, the lower that number is, the higher the result will be. So a smaller liveliness will push the realized price higher in that ratio. Now, liveliness trends lower and gets smaller when there's more hodling going on, right? In fact, let me just turn on so you can actually visualize it. You can see here that when liveliness is in a downtrend, it means that there's more hodling going on than spending. Conversely, much the same as the realized price, when all these old coins come back to life, there's a stack of lifespan destruction, old hands are selling, liveliness will trend higher. It's showing this destruction of stored lifespan. Now, what we're basically seeing is that this orange line here is that realized to liveliness ratio. And in a way, it kind of captures like the hodler implied value, right? So let's imagine this. If every single coin was spent tomorrow, then the realized price will collapse to the actual price, and the realized to liveliness price will also collapse to that, because you're dividing realized price by 1. Now, once that event happens, right, so we know that makes sense. Every single hodler spends, they know that this price is the correct price, everyone exits, we've now re-established the cost basis. If we then move into a period of mass hodling, one of these big downtrends, what's going to happen is hodlers are basically saying, I could spend, but I choose not to. So that implied, I'm not selling right now, I won't spend my coins, kind of implies that there's a higher price. They believe Bitcoin is worth more. And that's essentially what this orange line is picking up. It's kind of the hodler implied price. It's what the market believes Bitcoin is worth, because otherwise they would sell. And when they choose not to sell, their implied cost basis gets pushed higher and higher and higher. Now, what I find very interesting is that we bounced off this back in July. And here we are, 3 months of tussling around this thing, right? We are kind of on that hodler implied cost basis at a time in the market where we've already established that it's kind of only the hodlers that are left. There's plenty of macro reasons, plenty of bear cases. You don't have to look very far for those. And yet we just seem to be holding this strange psychological level. So that kind of, to me, it's showing that there's support here. There's psychological support here. It makes sense. We were back here in 2020. It's got a history of being a support. Now, in the worst case scenario, where we're going to get some kind, let's imagine we have our capitulation week. Well, the industry understands that the realized price is down here at 24,600. The probability that there is just an extraordinary bid sitting down there at probably not 24.6, probably 26, right? Front running it by some amount. Here's March 2020. There is a very high probability that there's a stack capital that simply won't allow it to get down below $25,000, right? And that really would be a pretty grim scenario. But if I zoom back here, I'll close out on this. If I look at the realized price and its performance, back in 2015, we didn't know the realized price existed. This was a brand new concept, came out in 2018. So back here, note that the market traded for about a year and found resistance, right? Traded for a year below it. This is human psychology playing out like a textbook over and over again because we react to our cost basis. Human beings are pretty predictable. That's why markets can be analyzed with technical analysis or on-chain or whatever else. So we spent 12 months below it back in 2015. We understood what the realized price was back here in 2018, and we spent 4 months, right? And once we broke above, right? We really started to rip. COVID, we spent 3 days, right? 1 year, 4 months, 3 days. What would happen if we had zero? And we actually buck this trend of coming down to the realized price because it's kind of priced in. The market knows that this thing exists now. What happens if we're actually now talking about a regime where this hodler to realized to liveliness ratio, this hodler implied cost basis, is actually taking on a more active role? It's becoming that psychological level that 2015 was back here. The market doesn't really know that this thing exists yet, but we're seeing the psychological reaction to it. So this is kind of my take in terms of it feels to me like this is a fair value. Anything below this realized to liveliness price, which is currently sitting at 40,000, anything below that to me is fair value and probably good value long term. And if you want to cap your risk, I would then argue that your realized price down here at 24.6 plus a little bit of front running is probably your risk. So if you want to actually limit downside or put some kind of stink bid in, that's kind of the framework that I would be taking. Keep it really simple. Something like this is going to give you immense edge because it's psychology. There's a reason why these things continue to work and react. It's because human beings are predictable, and in fear and pain and greed, we tend to do the exact same thing. But anyway, that's kind of my framework at the moment.
That's a really cool chart. And going back to your point earlier on around what else could the world throw at the markets right now? We've had a war, we've had inflation, we've had time and time again, tech stocks, trading like shit coins. What else could be thrown at Bitcoin for us to have another leg down? And I think a lot of the events in the past where Bitcoin's had that big leg down has been China banning crypto, Japan, Asia, US, whatever it might be. There's always been this event, but it's there's can be only so many events that happen. There's not too much more that you can go higher, right? What's next? A nuclear war,
Exactly. And there's all the anecdotal stuff about when you're in a bear market when good news ends up in a red candle, and you're in a bull market when you have bad news and you get a green candle. So start watching for that kind of shift, right? You can kind of ignore the rest of all the sentiment. That's all very noisy and hard to judge. But when you start seeing the market shrugging off, right, I guess at the end of the day, my gut feeling is that we seem to be shrugging off a lot of shit, right? Sure, the price looks a little bit grim, but it's shrugging off the kind of end of the world here. So, it's one of those very interesting dynamics where it's what do you do at the end of the world? Do you go long, or do you want to short it, right? What are you going to do with the money at the end of the world, right? So that's kind of my view is that I don't think the macro environment is going to get better. I think it is going to get worse. I think we still have to see this kind of how the Fed reacts, how stocks react. I don't think it's going to be pretty. And I also don't think Bitcoin's immune. But at the same time, I'm not seeing the hodlers getting scared. And I just ask myself, who's going to sell? Who is left to sell? And if they do sell, is it going to stick around? I mean, if Bitcoin goes to 24,000, I'm emptying my bank account. You know what I mean? Like, and there's a lot of people who are going to do the exact same. So, is it going to be is the market already pricing in the COVID 2020 massive wick? And everyone's like, oh, okay, here we go, hit buy. Like, are we just going to execute the exact same trade that we've just seen play out? I don't know. It's interesting, but in this very uncertain market, sometimes you just trust your gut, and I feel like the market's pricing in all this stuff ahead of time, which is why we managed to consolidate sideways the way we have for so long around what is an interestingly key level.
Yeah, brilliant. And I think just to wrap that up in a sense of some actionable takeaways, what I'm doing and sort of what I'm recommending to a lot of our members is that this is a time to educate yourself, whether it be Bitcoin, altcoins, NFTs, whatever it might be. Like, I'm using this time to not panic, not look at the charts, don't really give a shit. It's just about learning for me, learning about new opportunities, seeing what's value, seeing what's out there, looking at new opportunities, learning about staking, learning about lending, learning about Ethereum, learning about Solana. Like, just spending this time to research and look at those opportunities, because you don't get time to do that in a bull market. There's too much stuff going on when the market's going crazy, and every man and his next door neighbor wants to sort of chew your ear off about crypto. That's not happening right now. Like, now is the time to sort of step back and go, right, where can I use those 2 hours a day that I have to look into, something that's going to help me in the future. And I think that's a good way to look about, if you're not full-time in crypto right now.
100%. And in times like this, use some very, very simple models, because really when you're looking for these things, I mean, what I've got shown here is the Mayer multiple, which you'll hear me talk about all the time. It's just the ratio between price and the 200-day. And, let's combine those two metrics. We've got realized to liveliness ratio, which is kind of the on-chain cost basis. Just if you assume there that anything under 40K is going to be a value zone, right? There's model one, using on-chain psychology, all the rest of it. Mayer multiples just comparing to the 200-day moving average, which in many ways is kind of the age-old bull-bear technical indicator that every trader under the sun has been looking at forever and always will, right? The big investors, when they're looking for these massive billion-dollar allocations, the first question they ask is it above or below the 200-day? If it's below, I don't care. If it's above, then good. Let's start talking about a trend. So you can see here that when it goes below this green line, right, which is, I think this has got about a 20% probability. So only 20% of Bitcoin's life has ever been below this green line. And you can see that every time it's been down there, you map this thing forward another 6 months, 12 months, you're gravy. So here we are kind of hovering around the second line of confluence, which is at 38,500. You've now got two very simple models that are based on probabilities, based on historical performance, that can give you a value zone. And if you just sit tight and essentially accumulate anytime it's under this green zone, it's underneath the realized to liveliness, accumulate harder when it's under both. If you just follow those very simple rules, in 2 years, 3 years, 5 years time, you'll thank yourself, because you're not buying at these overvalued levels here back in January and February. You can start off loading those coins at that point. But if you have that time horizon in play, very simple models, very simple probabilities, it just puts you so much further ahead than everyone else. And when you've got confluence, bonus points.
Yeah, bang on. That's awesome again. And I think the going back to the goals that we spoke about, like what are you trying to do in crypto? And I think, whether you're looking to try to set yourself up for retirement, buy a house, flip, capital into crypto, it changes depending on what your goals are. And what we've spoken about today, you could interpret and action in different ways. So if you haven't got that ready, or you don't know what that is, it's important just to write a few things down, even just thinking about it, meditate on it, go for a walk, think about what you're trying to achieve, because I think that is the single point of failure or success. If you don't know what you're trying to do, you're going to find yourself selling your BTC at 38,000 because you want to buy back in at 34. That doesn't happen, you miss out, and now you've sort of missed out the opportunity, when in the grand scheme of things, it's going to be, like you said, it's just going to be a math error in the long, in the grand scheme of where we think we're going.
Absolutely. And this was my big takeaway, because when I got in at the absolute top in 2018, right? So I just got absolute smoked for a year and a half, but that's where I learnt the most. And what I finally understood, after losing 99% 3 times, is I realized that I never separated my trading capital, right, which I was flipping and trying to buy shit coins and all the rest of it, from my investment capital. My investment capital has a 5, 10, 15-year timeline, right? As you've kind of said, I'm mobile. I'm a kind of bit of a nomad at the moment. And, I can't take my house around. I can't carry lumps of gold through the airport. BTC, I can carry anywhere I want. So wherever I end up settling down, I can essentially move my wealth around. And just doing that actually has been amazingly freeing is kind of one word, but you recognize the value of BTC and crypto that you can carry around with you and move to any country, exchange it in fiat in any country that you want. But that is my kind of trading, my investment stack, right? I really don't care about price that much. I use on-chain to find value, and the rest of it is thinking about my future. In the short term, if you can have a 10%, a 5%, a 2%, whatever it is, trading bucket that you use to actually play within the market, and that in itself can be quite educational. So, just having that separation, know your rules in a trading range like this, right? Draw a line at the top, 42,000. Draw a line at the bottom, 35. If price breaks either of those levels with serious conviction, have already written down what are you going to do. If it just completely shits it and goes down to 35,000, what are you going to do? Are you buying or are you selling? Are you panicking or are you getting into the market? And likewise, if it starts to rip, are you going to FOMO in? Are you going to have buy orders there, or are you going to wait for it to pull? But have your rules set up and follow them, right? Understand what your invalidation is and just have a plan. If you think about it beforehand, when it happens, you're not shocked. And when you've written it down, you're more likely to execute. Because when you see a big red candle, it's one thing to write down, be like, I'm going to buy it. And then you see it and you're like, oh my God, right? That was me in March 2020. I was like, oh my God, 5,000. Okay, just hit it, just hit buy. But having written it down beforehand, I was ready to go when it happened. As scary as it was, I was willing to step in front of the train. And everyone was telling me that it was going to zero. And I was like, well, that's my plan. It's what I wrote down in the calm before the storm. That's what I wrote down, and that's what I executed on. And for better or worse, at least then you will learn from that mistake. And again, leave this thing for another 2 years. If you're buying spot, it's going to go back up, right? The reality is we're going to have more dollars in 5 years' time than we have today. So, if you just sit tight, you're going to get your money back, right? It's kind of one of those interesting realities. I don't think Bitcoin's going to die anytime soon.
Yeah, it's invaluable. I think those lessons, those experiences, Checkmate. And I think for me, mistakes I've made, going too heavy into some shit coins, getting overly emotional and very excited, and sort of bought the hype, and sure enough, down 70-80% now. And but I think that if you take a step back and look at what your goals are, what you're trying to achieve, for me, I've got that BTC that I've stacked and bought back in heavily sort of 2018 that I haven't touched. It sits in my ledger back home, and it's never going to be touched. And you can have your sort of play money or your trading money, or whatever you sort of call it, to play around with, and make those wins and losses. But to know that you're not trading all your capital at once or investing it actively, knowing you've got your long term sort of sorted, it makes things a lot easier and less emotional when you do make those mistakes, because it's all a part of learning, right? You're going to make those shitty investments, you buy at the wrong time, but that's how you learn and grow. So
you have to pay your tuition.
that's the lessons.
You have to lose money. If you don't lose money in markets, it will get you eventually. And the problem is, if you don't lose little bits here and there, you'll lose a lot one day, and it just sucks. So everyone has to pay their tuition. It's just one of those hard realities, but you learn some amazing lessons because you put skin in the game, and when you feel the pain, next time it happens, you're like, hey, I'm ready for this. I've seen this before.
I'm going to make one point here that I've sort of picked up on. Been at a few conferences over here in the US, speaking to a lot of people that are in crypto, and overwhelmingly, I'm seeing so many people still get stung by scams, and it's super scary. Like the impersonators, especially on Twitter. Speaking to a guy, like a business owner yesterday, who was showing me, he's like, man, I bought this NFT that, this, influencer, 800,000 followers on Twitter, said to buy. And he's like, I don't know what it is. And he paid a few $1,000s, like a treasure chest. He's like, what does it do? And I looked at him, I'm like, who sent you a message? He's like, oh, this influencer, like with 900,000 followers. And I'm like, man, I guarantee you this guy didn't send you a message saying to buy a treasure chest on OpenSea. And this is smart people, business owner, it's getting everyone. And I think it's super important to breathe, relax, do your research, search, Google search, triple check. We've got a bunch of free resources on our website. Anywhere, just learn and think about those opportunities. And like, if it's too good to be true, usually is. and you've got to be paranoid in crypto. Like I've come to learn that you've got to be paranoid. You cannot trust anyone. It's sort of the moral I've been going at.
And in many ways, I think that exact experience is something that we should also take as a sobering reality. What we are probably going to see, and you may have already started to get this kind of feeling and suspicion, you'll see that a lot of, now that the hype is kind of really starting to fade, it's probably going to continue to fade. We're not anywhere out of the woods. Things like when you see all of these scams, it kind of should remind you that this is not ready for mainstream.
Yeah.
You know what I mean? Like, most people don't want to get scammed, and the same thing is going to happen with a lot of, particularly in the crypto space. The further out the risk curve you are, a lot of the hopes and dreams you heard about 12 months ago simply ain't going to be so. And that is going to keep happening. This is kind of the nature of the bear. What happens is the money dries up, the devs get bored, they've got paid, they walk away. It's kind of the ICO thing again. You're going to see a lot of this start to happen. Projects will fall by the wayside, because we have to remember, all of these are startups. They're all startup companies, and 99% of startups fail, right? That's just the reality of markets, and crypto is arguably higher than that. So the probability that you've got the 1% is actually quite slim at the end of the day. And that's why, as you said, it requires that serious deep dive research. And another just final lesson from 2018, when you do the research, you may find an absolute gem. You may absolutely think that this thing is going to be the next whatever, right? And you could be very right. But that doesn't mean it's not going to go down 90% from here. So you can be patient in a bear market. You don't have to buy it the second that you're convinced. You can sit tight. You can start dollar cost averaging, take a little bite-sized chunk just so you've got an allocation, but you don't have to buy the whole lot right now. There is so much time between now and when this thing starts to kick off. You can do this whole thing very calmly. You can accumulate slowly. You can be patient, and your dollars will go further. And when the bull finally does come, if you're right, you're going to get more heavily rewarded because you are more patient to actually do the accumulation. So that's just another lesson that I took away from 2018.
Points. And for those sitting at home going, holy shit, this is just like too much. I don't have the time. What we're really trying to do, which at Collective Shift, this was my problem 2 or 3 years ago, trying to learn. Like, I'm not the smartest tool in the shed. What we've tried to do is build a team of experts to really bring you like the TLDR of the most important things you should know, because everyone's busy, everyone's got shit going on, and crypto is moving at such a rapid pace that we're trying to pull together some real experts in the space to help you sort of get ahead. And this is a post, for example, that Checkmate's doing 3 times a week for us around different areas of crypto. So Checkmate's focusing on on-chain analytics. We've also got Nick and the guys focusing on different chains. We've got altcoins, NFT stuff. We're just trying to bring you the most important things, and we've got those resources, those educational materials, which is all free. So you can jump over here. Got top tutorials where how to avoid the scams, what are NFTs, what is Bitcoin, how to buy. We've got all of this stuff over on the platform you can check out, as well as our investment. So what we're trying to build as well is for those that are still trying to figure out and don't know when to buy, how to buy, what to buy, we're building these portfolio strategies where you can basically copy what we're doing. And what you'll notice is that we're nowhere near 100% strike rate. Like some of the NFTs or even early stage opportunities, this is super risky stuff. Like, we're sprinkling seeds, small investments. Some are down 80%, some are up 400%. And these are not micro coins. Like, we're still aiming at like the top 1,000, but it is super risky, and it's difficult to do this alone. So we're trying to deliver that research and give you the more of the trusted on-chain backed analysis to help you along the journey, which Checkmate's a great part of that. So you can go over and check that out for I think we're doing a 7-day $1 trial, which you can check out and then cancel any time if you don't love it. But it's just this space is moving so fast. It's too hard to do alone. I've found.
And that's the thing, right? So, you'll often hear me kind of be more critical of altcoins, but that doesn't mean that there's not a huge amount of value in all this kind of stuff. What I certainly try to provide you guys all with is, I still see that, we continue to see that Bitcoin is kind of the bellwether. So if you can kind of see where the big tide is moving, you can then start, work out which ships within that tide are going to start moving the fastest. So, I think that's kind of the way to take a lot of this stuff away. And the reason I focus mainly on Bitcoin is because it gives you kind of the big picture. Once you understand the directionality of things and the macro tide, you can start positioning yourself within that. So, that's kind of the framework that you should be taking it with. Understand the big picture direction, and Bitcoin remains kind of that. If you do just want to park money away and not have to worry about it, it's that long-term savings vehicle. That's the way that I view it. That's kind of the asset that you have for that. And as you get later into the cycle, and remember, this thing is a cycle. The funds flowed from Bitcoin down to Ethereum, from Ethereum down to Alt L1s, and then into tokens. This is this sector rotation we continuously see play out. And it's kind of one of those things that because the market expects it, becomes a self-fulfilling prophecy. So, you can be patient and just watch this macro flow over time, and, reposition accordingly and kind of follow the cycle through and then rinse, repeat.
100%. Brilliant. That's about an hour, mate. Thank you so much. I really enjoyed that. That was a good discussion. We've got the internet to work finally, so that was good.
That's it. No, it's good. Until you've been through a bear market, you just don't know what they're like. And hearing from people who've been through bears before, the amount of wisdom that you can gain from just hearing their experiences hopefully puts you that just half a step ahead of everyone else.
100%. So you can jump on Collective Shift and see all Checkmate stuff. He's also posted some great free content on Twitter as well. So head over there. I think just Checkmate is your handle, I believe. Yep. Awesome.
That's it. Checkmate, yep.
Thank you so much for your time again, mate, and we'll see you next month.
Good stuff. Thanks, folks.